Okay, so you're here because you want to get the most out of your study time with these materials. We're talking sustainable ROI, project finance, cost-benefit analysis, quite a bit to cover.
Right. And our mission, really, in this deep dive is to pull out the absolute must-know concepts.
Exactly. How do they all link together? What's, crucial to remember for the test? We want to build a really solid foundation here.
Yeah, think of it like building a toolkit. Sustainable ROI, project finance, CBA, all those financial metrics,
Hmm.
they're the tools for understanding these big investment and development decisions.
Especially now with sustainability becoming so central.
Precisely. It's a major shift.
All right, let's start unpacking sustainable return on investment, SROI. We probably all get traditional ROI cash benefits back to the company, right?
Pretty much financial gain from an investment. But sustainable ROI, well, it casts a much wider net. It looks at cash and non-cash benefits.
Okay, so what drives that broader view?
It's this idea of the triple bottom line, the green economy focus. Economic, yes, but also societal and environmental factors.
People, planet, profit.
Exactly. So sustainable ROI isn't just about the company's bank account. It's about the wider impact.
Hmm.
For your studying, that's a key takeaway. It's moving beyond just shareholders to think about all stakeholders.
Got it. And to really dig into that, we need life cycle cost analysis, LCA.
Right. Traditional LCA is all about the money trail over a project's life.
Like the initial cost, running costs, getting rid of it at the end.
Yep. Capital expenditures, operating maintenance, decommissioning, and crucially, it adjusts for the time value of money. A dollar today isn't worth the same as a dollar in 10 years.
Standard finance principle. So how does sustainable LCA differ?
It takes that financial base and adds layers. It integrates those non-cash impacts we mentioned.
Gotcha.
Things like lower carbon emissions, maybe less water usage, improved health for workers or the community, reduced waste. Real-world benefits.
So it gives a much fuller picture of the project's actual return.
Definitely. A more comprehensive view. So for your prep, remember, sustainable LCA uses a wider lens than just the financial numbers.
Okay. Now, just to make sure we're grounded on the financial side of ROI, maybe a quick refresher on basic financial statements, just for context.
Good idea. The income statement that shows performance over time. You've got your net sales, cost of sales, gross margin.
Operating expenses, EBIT, interest, all the way down to EAT, earnings after taxes, net income.
Exactly. And then the balance sheet, that's a snapshot. What a company owns, its assets.
Cash, securities, receivables, inventory, plant and equipment.
And how it paid for them. Liabilities, what it owes, and stockholders' equity, the owner's stake.
Accounts payable, debt, common stock, retained earnings.
Right. Understanding these statements is like the bedrock for calculating those financial metrics. You need this baseline.
Okay, makes sense. So with that, financial ROI, the formula is EET divided by total assets.
That's the one. So for our example, XYZ Corp. $5,148,000 in ET, $81,690,000 in assets, gives you 6.30%.
So what does that 6.30% actually tell us? What's the core idea?
It tells you how productively the company is using all its assets, everything it owns, to generate profit after all the bills and taxes are paid.
So higher is generally better? More efficient?
Generally, yes.
Mm-hmm.
Higher ROI suggests better asset utilization. For your studying, know that formula and what it represents. Asset productivity leading to profit.
Okay. And the other one we looked at was financial return on stockholders' equity, ROE. That's ET divided by equity.
Correct. Using XYZ Corp again, same $5,148,000 EET, but now over $34 million in equity. That gives you 15.14%.
Higher number. What's the takeaway here?
ROE zeroes in on the return generated specifically on the money the shareholders invested. It's a key metric if you're an owner or potential investor.
Right. So ROI is overall asset efficiency. ROE is return to the owners.
You got it. That distinction is important to grasp for the test.
Okay, so we have the traditional view. Single bottom line, profit, keep shareholders happy. But the green economy introduces that triple bottom line, profits, people, planet.
And this isn't just a minor tweak. It's a fundamental paradigm shift, moving from one stakeholder group shareholders to many stakeholders, customers, employees, communities, the environment.
So why is this happening? Is it just, feeling good?
Well, partly, perhaps, but increasingly it's about hard-nosed business sense. Companies are realizing sustainability is actually good for the bottom line in the long run.
How so?
They're starting to truly value natural resources, understanding that a healthy society underpins a healthy economy, and seeing how integrating ESG, environmental, social, governance factors actually helps businesses prosper.
So it's both ethics and economics driving it.
Absolutely. For your prep, remember that dual motivation. It's not just altruism.
And the benefits are pretty clear.
Yeah, the list is long. Attracting investment, huge one right now. Building more resilient supply chains, reducing reliance on volatile resources, opening up new green markets, creating jobs.
Higher growth in the medium to long term, competitive advantage, better ROI.
Exactly. It all connects. And think about the scale estimates are over $1 trillion needed annually for the green transition. That's immense opportunity.
And investors are paying attention.
Increasingly, environmental performance is becoming a proxy for good management, for future-proofing a company.
Which brings us neatly to corporate sustainability itself. What does that look like in practice?
It means operating in a way that's low carbon, resource efficient, and socially inclusive. And you get there through targeted investments.
Investments that cut emissions, boost efficiency, protect ecosystems, maybe alleviate poverty.
Precisely. And we saw some great examples. Puma, doing environmental profit and loss accounting, they figured out reducing their environmental damage actually lowers their financial risk from future taxes or resource costs.
Smart. And Unilever.
Their sustainable living plan, a huge company trying to decouple growth from environmental impact. Really ambitious.
Then there was Equity Bank in Kenya.
Yeah, offering low-interest loans for things like water-efficient irrigation. That's the private sector spotting a green business opportunity.
And the coffee growers in Colombia with Rainforest Alliance certification.
A classic example. Sustainable farming increases productivity and gives them a brand advantage. These examples really show it's possible, right? Sustainability and profit working together. You should definitely recall a few of these for context.
Definitely useful illustrations. Okay, so what are the big underlying forces pushing this whole shift?
Well, resource scarcity is a massive one. Population growth, the rising global middle class demanding more stuff, plus environmental stresses is putting pressure on resources.
Like food, energy, water, materials. Projections show demand soaring.
Exactly. And linked to that are constraints in production. Our current systems, agriculture, energy, manufacturing, they have limits. And frankly, business as usual just isn't sustainable environmentally.
So companies are forced to think differently. Efficiency, recycling, durability.
They have to. But it's not just push, there's also pull. Consumer demand is a big one.
People wanting greener options.
Yeah, consumers are way more informed now. They're actively looking for sustainable products and services. It's creating this green race where sustainability becomes a competitive edge, a strategic driver.
So given all that, how do we actually get to a green economy? What are the pathways?
The sources point to a few key strategies: doubling down on resource efficiency, doing more with less, investing in and scaling up clean technologies, developing alternative products, services, materials.
And finding ways to turn waste into something valuable.
Exactly. Waste transformation. That figure 2 in the Unity reading give a good visual map of this across different sectors. Worth reviewing.
Okay. And this ties into the green business case model.
Perfectly. That model just lays out the clear link. Sustainable actions lead to positive indicators, which drive real financial value.
What kind of actions and indicators?
Actions like adopting clean tech, educating staff, better risk management, offering sustainable goods. These lead to indicators like a better risk profile, easier access to investment, improved productivity, attracting more customers, stronger brand value.
And those indicators translate into
Financial value drivers. Things like sales growth, better profit margins, lower capital needs, maybe better tax treatment, lower costs of capital. It's a clear causal chain. For the exam, understanding that model connects the why of sustainability to the how of financial benefit.
So sustainable ROI isn't just a fuzzy concept, it's built on this logic.
Precisely. It goes beyond the immediate financials because fostering better socioeconomic and environmental conditions actually creates a healthier environment for businesses to thrive in long term. Sustainability is part of value creation.
And the evidence backs this up. Sustainable companies perform better.
Research increasingly suggests they do on key metrics. Enhance sales because markets and regulators demand it, and customers are willing to pay a premium sometimes.
Reduce capital expenditures maybe through smarter design, like green chemistry examples.
Improve profit margins from being more efficient with resources and supply chains. Potentially lower taxes through incentives. Lower cost of capital because they're seen as less risky.
And stronger brand value, using standards and labels. It all adds up.
It really does.
So for business leaders wanting to make this happen, what should they be doing?
The reading suggests several things. Adopting broader valuation methods, think human, social, natural capital. implementing life cycle thinking right through the value chain.
Focusing on stakeholder value, not just shareholder value.
Demanding sustainability from suppliers. Engaging employees, that's crucial. And making sustainability a core board-level priority.
And we saw some show me the money examples of this paying off.
Absolutely.
Yeah.
GM saving big bucks through resource productivity, wind energy creating tons of jobs in Europe, Grupo Bimbo cutting water costs.
Nespresso boosting sales with sustainable coffee. Siemens getting payback on wind turbine manufacturing. Sumpo Japan's weather insurance. Shree Cement capturing waste heat.
Concrete examples. They show sustainability isn't just theory, it delivers financially. These are good ones to have in your back pocket.
But it's not all smooth sailing, right? What are the hurdles?
Definitely challenges remain. Financial short-termism is a big one. Pressure for quarterly results can overshadow long-term sustainable investments.
Lack of supportive regulation, or worse, conflicting rules.
Yeah, and sometimes just a lack of understanding of why this is so imperative. Market pull can be slow in some areas, and the lack of consistent international standards makes it harder for global companies.
So lots of progress, but still work to do. For the test, knowing these challenges is probably important too.
Agreed. It gives a balanced perspective.
Okay, let's switch gears now to project finance. This is about funding those really big, often infrastructure-type projects.
Right. And a key thing to focus on here is risk. Specifically, the risks faced by the people providing the capital, the lenders, and investors.
And how legal agreements, contracts, guarantees are structured to manage that risk and get the funding flowing, often through what's called a special purpose vehicle, or SPV.
Exactly. The SPV is a separate legal entity created just for the project. And the main point of all the legal paperwork is really to protect the lender's money. That's job one.
And these projects often involve a lot of debt, right?
Typically, yes. A very high debt-to-equity ratio is common. And critically, those loans are usually secured primarily by the project's expected future cash flows, its physical assets, and the SPV's legal rights under its contracts.
So not necessarily relying on the big balance sheet of a parent company.
That's the idea of non-recourse or limited recourse finance. The lenders look mainly to the project itself for repayment.
Which means the performance of everyone involved is absolutely critical.
Paramount. Engineers, constructors, suppliers, the operator who runs the facility day to day. If any of them drop the ball, it can jeopardize the whole project's financials and the lender's security. For your studies, remember project success really hinges on reliable performance from all these parties.
And putting one of these deals together sounds incredibly complex.
It is. You need coordinated efforts from lawyers, financiers, engineers, technical experts, all working together, anchored by a whole suite of carefully drafted, consistent legal documents.
Okay, so the money itself, the financial instruments, you mentioned debt and equity.
Broadly, yes. And it's crucial for you to understand the basic differences. Priority of payment, rights to payments, voting rights, tax treatment, expected returns. They differ significantly.
Debt gets paid first, usually has fixed payments, no control. Equity gets what's left, might get dividends, often has control.
That's the gist of it. Debt holders are creditors. Equity holders are owners. Knowing those core characteristics is vital for the test.
So on the equity side, we have common stock.
Right, that represents the actual ownership share. Common stockholders usually get voting rights, maybe dividends if the project is profitable. Their investment is typically the riskiest, especially early on.
They often provide the initial seed capital.
Exactly. And the shareholder agreement between them is a really important document outlining their rights and obligations to each other.
And preferred stock.
Another type of equity. Usually no voting rights, but they get priority over common stockholders for dividends and if the company is liquidated. A bit less risky than common stock.
Okay, moving to debt. Bonds are a big one here.
Very common. The SPV issues a corporate bond. Let's say it has a face value of $1,000. It promises to pay a fixed interest rate, the coupon, maybe 8% per year. And it has a maturity date, say 10 years, when the $1,000 principal is repaid.
So in that example, the investor gets $80 a year.
Usually paid semi-annually, so maybe $40 every 6 months.
And then gets the $1,000 back at the end of the 10 years.
Exactly. And remember, for the investor, the interest earned on a corporate bond is generally taxable income. That's different from some tax-exempt government bonds.
So fundamentally, a bond is just a loan from an investor to the SPV.
Precisely. A debt investment. The investor lends money for a set period at a fixed rate. Companies, governments, SPVs, they all use bonds to raise capital for big projects.
And the interest rate, the yield, depends on.
Primarily the borrower's credit quality, how likely they are to repay, and the duration, the maturity of the bond. Longer term usually means higher yield to compensate for more risk over time. Bond maturities can range from short term to very long term.
Right, which we see reflected in the yield curve.
Exactly. The yield curve just graphs interest rates against maturity for bonds of similar credit quality. Typically slopes upwards, higher yields for longer maturities.
Okay. Now, back to this non-recourse idea. If lenders can only look to the project, how do they get comfortable? What's their security?
Great question. Even without direct claims on the parent companies, lenders need solid security. This can include mortgages over the physical assets, assignment of the project's contracts.
Like the contract to sell the power or water?
Exactly. Also, rights over intellectual property, insurance policies are key, and often specific limited guarantees from parent companies or other forms of sponsor support to backstop certain risks.
So the contracts themselves are part of the security package.
Absolutely central. Contracts create the whole legal framework. They define who's responsible for what and what happens if someone doesn't deliver. They're the main way risks get allocated and transferred.
Like the buyer takes the market risk with an offtake agreement.
Right. Or the construction contractor guarantees performance and takes construction risk. The operator takes operations risk through the O&M agreement. It's all about assigning risk to the party best able to manage it.
But disputes can still happen.
Oh, definitely. On long, complex projects, disagreements or claims are almost inevitable. Good agreements have clear dispute resolution processes to sort things out fairly and quickly. Keeping the project on schedule is paramount, so finding win-win solutions is often best.
Okay. So the main debt contract is the loan agreement.
Yes, or sometimes called the bond indenture or deed of trust if it's a bond issue. That's the master contract between the SPV, borrower, and a trustee representing all the lenders. Spells out all the terms, conditions, responsibilities.
And there's a security trustee?
Often, yes.
Hmm.
Usually a bank. Their job is to manage the project's money according to the loan agreement. They oversee the escrow accounts set up under the security agreement, making sure revenues come in and payments go out correctly, first to lenders, then others, provides financial control.
Let's talk about some key contracts. The purchase agreement or offtake agreement.
Critically important for projects selling an output, like power plants or water treatment facilities.
Hmm.
This is where the SPV transfers market the risk of not being able to sell its product to a credit-worthy buyer.
Often a take-or-pay deal.
Very common. The buyer agrees to pay for a minimum amount of output, whether they actually need it or not. In return, they usually get a stable, predictable, long-term price, essential for securing finance.
And the operations and maintenance O&M agreement?
Usually a separate deal with a specialist O&M contractor, defines exactly what they have to do to run and maintain the facility, the performance standards they must meet, and the penalties if they don't.
And the SPV needs to be able to enforce that.
Absolutely. The O&M performance directly impacts revenues and the ability to pay back debt. So the SPV needs mechanisms to monitor the O&M contractor and, if necessary, replace them if they're underperforming.
Okay. You mentioned parent company guarantees earlier, even with non-recourse finance.
Yes, they're quite common, despite the non-recourse label. Lenders often want extra comfort from the financially stronger parent companies, involve the main engineering firm, the tech supplier, the operator.
But these guarantees are usually limited.
Often limited to the parent's specific area of responsibility or maybe capped financially. They get disclosed in the parent's financial statements. In joint ventures, you might see joint and several liability, which is riskier for the parents. Negotiating these guarantees is always a big deal.
Makes sense. So stepping back, what are the main objects of risk management on these big projects?
Health and safety is always paramount. Beyond that, you worry about political or social issues, physical damage, technical problems, regulatory or tax changes, environmental damage, and, of course, financial losses. A formal risk register tracks all this.
So you need a process.
A formal risk management process, yes. Starts with comprehensive risk identification, list everything that could go wrong. Then, risk quantification, assess the probability and the potential impact on cost and schedule. You even need to consider those low probability, high impact black swan events.
Then you develop a strategy for each risk.
Right, a management strategy and contingency plan with someone clearly responsible for executing it. And regular monitoring is key. The mantra is, avoid the risk if you can, mitigate it, transfer it, like with contracts or insurance, share it, or consciously accept it. Just hoping for the best is not a strategy.
Insurance is one way to transfer risk.
It is. You pay premiums to an insurer, and they cover certain large losses if they occur. But not all risks are insurable.
Why not?
Insurers need to be able to quantify the likelihood and potential damages. So things like fire, flood, theft, professional negligence, usually insurable. But risks like war, civil unrest, government expropriation, technology becoming obsolete, generally not insurable.
How does the insurance transaction work typically?
Often, a main contractor takes out the necessary policies, construction risk, liability, and names the SPV as an additional insured party. The cost of the premiums usually gets passed through to the SPV. If an insured event happens, the insurer pays out according to the policy.
Okay. And surety bonds. They're different from insurance.
Yes, important distinction. A surety bond isn't insurance. It's a three-party guarantee. You have the contractor, the principal, the owner SPV, the obligee, and the surety company.
And the surety guarantees the contractor's performance.
In specific ways. Bid bonds guarantee they'll sign the contract if they win the bid. Performance bonds guarantee they'll complete the work. Payment bonds guarantee they'll pay subcontractors and suppliers. Retention bonds cover defects after completion.
But if the surety has to pay out,
They expect full reimbursement from the contractor. It's not like insurance where the premium covers the potential loss. That's why a contractor's ability to get a performance bond is seen as a sign of their financial strength and track record.
got it. Okay, let's shift again to cost-benefit analysis, CBA, and those related financial metrics. Why are these so important?
Because resources are always limited,
Right.
right? Policymakers, investors, companies, they all need ways to evaluate choices and make decisions. CBA and similar tools are crucial for assessing green investments, corporate initiatives, public policies.
Comparing options systematically.
Exactly. Key metrics include CBA itself, which can be static or dynamic, cost-effectiveness analysis, and impact analysis. Different tools for different situations.
Let's focus on CBA first. It's used to evaluate green choices.
Widely used. The basic idea is simple. Is a policy or project desirable? Yes. If the benefits B outweigh the costs, C, so BC, or the benefit-cost ratio BC1, the net benefit is just B minus C.
And the key is valuing B and C broadly.
Yes, ideally considering impacts on the whole ecosystem, not just direct financial costs and benefits.
Which brings an opportunity cost.
Crucial concept. The opportunity cost of using a resource one way is the lost net benefit from its best alternative use. Your example was clearing a forest for agriculture. The opportunity cost is the lost value of the forest.
So when calculating net benefit, you have to subtract that lost opportunity. Like the river example, the opportunity cost of building a hydro dam is the lost recreational value.
Precisely. For your studies, always ask, what's being given up? That's the opportunity cost.
There was also a cost-benefit graph mentioned.
Right, showing marginal benefits,
Right.
demand curve, and marginal costs,
Mhm.
supply curve.
Mhm.
Where they cross is typically the point of maximum net benefit.
And the steps for analysis are find the optimal outcome, figure out why we're not there now, design a solution, like
Oh.
the ocean fisheries example.
Exactly, a logical process.
Okay, need to clarify optimal versus efficient.
Good point. Optimal means maximizing the overall net benefit, considering all types of benefits and costs.
Yeah.
Efficient, in economic terms, usually means allocating resources to maximize the net economic or financial benefit. So an optimal outcome is also efficient in that broader sense.
Like preserving 5 miles of the river was optimal based on the balance of benefits and costs in that graph.
Correct.
And the first equimarginal principle.
That just formalizes it. Social net benefits are maximized when social marginal benefits equal social marginal costs. The intersection point on the graph.
Pareto optimal.
An allocation where you can't make anyone better off without making someone else worse off. A theoretical benchmark for efficiency.
Now, benefits and costs over time, this is where present value comes in.
Absolutely critical. You can't just add up dollars received or spent in different years. You need to discount future values back to today's terms using the present value PV formula.
PVN, 1 plus RN, for a single amount, or the sum of PV by 1 plus RI for a stream over A years using a discount rate R.
You got it. We did that calculation in problem 1. For your test, you absolutely need to be comfortable calculating PV. It's fundamental.
And this leads to static versus dynamic efficiency.
Right. Static efficiency ignores time, just compares benefits and costs happening now. Dynamic efficiency explicitly incorporates time by using PV calculations before comparing. Most real-world projects need dynamic analysis.
Like the EPA's Clean Air Act CBA that looked at benefits over many years.
A massive undertaking, quantifying reduced deaths, illness, improved visibility, agriculture. a prime example of dynamic CBA.
We also contrasted preservation benefits like recreation, habitat, carbon storage with development benefits, jobs, income, goods.
And the Costa Rica tropical forest discussion was fascinating.
Yeah, valuing the pollination services of wild bees for coffee farms showed significant economic value, like $60,000 a year, often totally overlooked.
Plus other services like water purification, carbon storage. It really drives home that nature have quantifiable economic value. Remember that example? It powerfully illustrates valuing ecosystem services.
Okay, benefit estimation. Primary, secondary, tangible, intangible.
Right. Primary are direct effects. More fishing revenue from a clean lake.
Mm.
Secondary are indirect. More jobs at bait shops. Tangible can be easily monetized. Intangible, like scenic beauty, are harder but should be quantified if possible.
And cost estimation approaches. Surveys, engineering data, or combining them.
Each with pros and cons regarding bias or accuracy.
The green buildings discussion also hit on this valuation challenge.
Yeah, identifying tangible benefits like lower utility bills, but also intangibles like occupant productivity or wellness. And why are they future-proofed? Probably because they're resilient to rising energy costs and new regulations.
And the recommendation was likely a valuation method that captures those long-term life cycle benefits.
Seems logical. For your studies, think broadly about all the benefits and costs, tangible and intangible, when evaluating green options.
And we can't forget distribution. Who wins, who loses.
Crucial point. CBA might show a net positive overall, but how are the benefits and costs spread across different groups? That raises issues of equity, environmental justice. We need economic impact analysis and equity analysis.
The Costa Rica case mentioned distributional effects too.
Yes, who benefits from forest preservation versus conversion?
Selecting the discount rate, always tricky.
Very. It reflects the cost of capital, usually a risk-free rate, plus a risk premium. But the rate chosen has a huge impact on the PV, especially for long-term benefits. Higher rates shrink future benefits more.
We saw that clearly in problem 2. The project's NPV was positive at 5%, but negative at 10%.
Exactly. In problem 3, the wind farm had a negative NPV at 7%, leading to a do not proceed recommendation based purely on that metric. Understanding discount rate sensitivity is key for the exam.
But CBA isn't perfect. What are the shortcomings?
Estimation is difficult, can be unreliable, prone to biases, intentional or unintentional, and the standard CBA doesn't automatically address those distributional equity issues.
Right. So if CBA isn't feasible or reliable,
Then you might use cost-effectiveness analysis. Here you set a specific goal like reducing pollution to a certain level, maybe based on expert opinion, and then find the lowest cost way to achieve it.
uses the second equimarginal principle. Equalize marginal costs across different methods.
Exactly. Find the cheapest mix of technologies to hit the target.
And if even that isn't possible.
Then you might do an impact analysis. This just identifies and quantifies the likely consequences, financial, environmental, social, of different options, without necessarily trying to optimize or find the best one in economic terms. It generates data for decision makers.
This led to things like environmental impact statement.
Right. It highlights the trade-offs and forces a consideration of the balance between human benefits and environmental protection, which is fundamental for sustainable growth.
Okay, last major topic, public-private partnerships or PPPs. Engaging the private sector for public infrastructure.
Correct. A PPP is basically a contract between a public agency and a private company to deliver a public service or facility. They share skills, assets, risks, rewards. It often uses project finance techniques for public assets. For the test, think of PPPs as a way governments can leverage private sector skills and money.
Why the interest in PPPs?
Several drivers. Rapid growth straining existing infrastructure, old infrastructure needing replacement, but public budgets are tight. Policymakers hoping for better performance, more efficiency, access to private management, technology, and finance.
But they don't always work out perfectly.
No, definitely not. There have been some high-profile disappointments, especially in developing countries, sometimes due to poor planning, underestimating complexity and risks, or just an unsuitable legal or market environment.
The World Bank assessment of water PPPs showed mixed results.
Exactly. It's not a magic bullet.
Jeffrey Dellman had a simple definition.
Yeah. Private sector delivering infrastructure service for or assisting the public sector. Nice and broad.
And there's a whole spectrum of PPP models.
Right, based on how much responsibility and risk the private sector takes on. It ranges from corporatization, where the public entity just acts more like a business,
Through standard government procurement, like design bid build.
to things like management and operations contracts, where private firms run specific services like billing or IT.
Then leases and afferage, where the private sector operates public assets and collects revenue, but doesn't own them or finance major upgrades.
Moving further, you get DBO, develop, design, build, operate, and BOOT, build, own, operate, transfer projects. Here, the private sector does much more, sometimes including finance and temporary ownership before transferring assets back to the public sector. Concessions are similar, but often longer term and cover whole systems,
Joint ventures, too, where public and private share ownership.
like the Impresa Mixta model. And at the far end, full divestiture or privatization, where the asset is sold off entirely and the public sector just regulates. It's important to understand this continuum. Different models suit different situations.
The value of good upfront planning in PPPs was emphasized.
Absolutely. Investing time and resources in proper project development, like doing benchmarking studies, as in the Tollwater case, is crucial. And evaluating whole-of-life or life cycle costs is key.
Seattle's DBO contract looked at 25 years of operations.
Right. That long-term perspective is vital. Comparing PPP lifecycle costs to traditional public delivery often shows higher upfront costs for PPPs, but potential savings later through efficiency and risk transfer.
Jeffrey Dellman highlighted key success factors: political will.
Absolutely essential. A stable legal and regulatory setting free from corruption, and rigorous planning by the public sector, choosing the right projects, running fair procurements, allocating risks appropriately. Can't just assume the private sector will magically solve everything.
His framework mentioned the commercial and financial context needing to be right, too.
Stable institutions, viable revenue streams, access to private capital, lots of elements need to align.
And the National Council for PPPs had 7 keys.
Yeah, a good checklist. Public sector champion, political will again.
Yeah.
Enabling laws. Dedicated public team doing value for money analysis. Detailed business plan with clear risk allocation.
Identifiable revenue stream. Stakeholder engagement, very important. And selecting a capable, financially strong private partner. For your studies, focusing on these success factors is probably a good bet. So the bottom line for PPPs is careful collaboration, understanding the complexity, having the right conditions, and meticulous planning.
That sums it up well.
Wow. Okay. We've covered a huge amount of ground. Sustainable ROI, project finance, CBA, PPPs.
We have. And hopefully you listening can see how these pieces fit together now. You've got a framework covering the why, sustainability drivers, the how, project finance mechanisms, and the evaluation, CBA, and other metrics.
And interconnectedness is key, right? Sustainability influencing investment and finance, financial tools being used to assess green projects.
Exactly. It all ties together.
So as you go back to the materials, what should you really focus on?
I'd say nail down the core definitions. Understand those key formulas, ROI, ROE, PV, and what they mean. Grasp the drivers and benefits of the green economy. Know the basic stages and major risks in project finance. And get the principles of cost-benefit analysis clear in your head.
Build that scaffold of understanding across all the topics.
Precisely. That will serve you well.
Okay, one final thought to leave you with as you continue studying.
Considering this increasing integration of sustainability into finance and infrastructure, what do you see as the single biggest opportunity or perhaps the most significant challenge emerging from this whole evolving landscape?
Something to ponder as you dive back into the sources.